All right, everybody. My name is Stephen Fletcher. I'll be introducing our next speaker. So this is David Blaine, CEO and Senior Wealth Advisor at Blue Sky Wealth Advisors, and also my boss. David is a West Point graduate, investor in real estate for over 25 years, CEO of Blue Sky for 20 years now, and avid real estate investor. So, David?
Okay, great. Thank you. First of all, this has been a great conference. Thank you all for sticking around for this. I'm going to make sure that you're rewarded for staying late. How's that volume? It's kind of echoey. Okay. So we got a great presentation here on investing in real estate. So before I get started, how many of you use real estate in your practice besides REITs? Anybody? Just kind of want to get a feel for how to tailor the talk. Okay. Who uses REITs in their portfolios? Does anybody use? Okay, a few more. How many of you own real estate? How many of you own your own building? If you're the owner, or other investment properties, rental properties, things like that. Okay, great. So what we want to do today is I want to talk about real estate as an investment. As Stephen said, my first career was in the military, and when I was stationed in different places, I started buying these houses as rental properties, and I got moved different places, and so I started accumulating some real estate, investing in stocks and bonds. When I left the military to make money, I did fix and flip for several years, while my RIA that I started with no experience, I billed $875 my first year in business. And so I needed to make some money, so I did fix and flip. So I've done a lot of investing. I've developed entire neighborhoods, 500-acre developments. I've owned commercial properties, residential. And I just tell you that because I am my full-time job is a NAPFA advisor. Just like you, I advise clients from day to day. But I have a lot of experience in investing in real estate, and I want to introduce that world to you today because I find that either some people, they just ignore it. Hey, real estate, that's not my thing. I'm just doing retirement planning or stocks and bonds, which is not a good answer. It's my feeling as a fiduciary that we are supposed to provide the very best advice for clients in their circumstances, and in a lot of cases, the addition of income-producing real estate is part of that formula. So that's just kind of my introduction. We've got a small group here, so if you have questions in the middle, please raise your hand. We'll go ahead and stop. I really want this to be useful for you. I've got some slides to go through, but please, we'll save some time at the end for questions. But if it's something that's relevant to what we're talking about, please go ahead and interrupt. Okay, so first we're going to talk about why real estate. Second, the risks involved. Just like any investing, there are risks involved. Number three, which is kind of key, who should invest in real estate? What is the profile of a client that should invest in real estate? And number four, how do you design a real estate portfolio? It's no different than your accounts at Schwab or Fidelity or TD, wherever you custody. We have investment policy statements for real estate. And it outlines a lot of the similar things you probably have in your IPS for a normal portfolio. What's the objective of the portfolio? How are we going to diversify it? What are we hoping to achieve with this portfolio? And how you design it. It's rather simple, especially, we're a passive advisor. We follow index strategies with our portfolios. We use some DFA funds. So pretty traditional on the portfolio side. The same thing, we bring that to our real estate portfolio, is very academically based, very solid research based. This is not, speculative land. I hope that some tenants come in this building. So we'll talk about how to design a portfolio. And then the last thing we'll talk about is the vehicles that you can use to invest in real estate. How do you invest in real estate? And I'm going to introduce a chart to you here today. This is actually from my book. I have a chapter in my book on investing in real estate. And I designed this graphic here to kind of explain what I call the real estate continuum. And I'm going to show it, as I say, begin with the end in mind. We're going to bring this back at the end, but I want you to kind of plant that seed in your mind about real estate. Over on the left side of the slide, we have own and manage local property. This is somebody that goes out and buys a rental property, you know, down the street or in their hometown or something like that. They're finding the tenants, they're collecting the rent, they're fixing the toilets, you know, all that stuff. And then over on the far right-hand side is the REIT mutual funds. Like many of you that raised your hand, you know, this is a publicly traded REIT, you know, the Vanguard REIT, the Schwab REIT, you know, one of those type of funds. And in the middle, there are a lot of different ways to invest in real estate. There are pluses and minuses on both ends. But I just want to introduce that concept to you that investing in real estate is a continuum. And there's not just one way to do it. So we'll talk about why real estate. Number one, it's a large part of the global market. If you're not investing in real estate, you're ignoring a huge asset class. Huge asset class. Number two, competitive returns. The returns of commercial real estate are, it's somewhat hard to measure. We'll talk about that in a minute, but by any reasonable measure, it's at least as good or better than the equity markets. Cash flow and growth provides both inflation protection, diversification from your liquid portfolio, and the last one, which I really like, tax advantages. At Blue Sky, we actually prepare our clients' taxes. We're really into tax things, and one of the things I love about real estate is a really tax-efficient way to make money and accumulate wealth. Okay, so we have here the global market portfolio. This was from Shire Meyer, an author. It's really hard for those of you that approach investing as far as being able to capture the returns of the market. The global market set is sort of one of the fascinations of mine, is what comprises all the different things you could possibly invest in the world. And it's really hard to measure. But no matter how you measure it here, you'll see the real estate broken down, North America, Europe, Asia Pacific, you know, somewhere around 7% of the global market. Now this is publicly traded. This is by ETFs. It's a little bit hard to see, but this is a proxy portfolio of the global market set, and you can see there RWO is about 7% of the global market is real estate as comprised with ETFs. Here we have U.S. commercial real estate, high estimate $17 trillion, low estimate $14.4 trillion. Okay, this is a large market. It's a large asset class that deserves your attention. Once again, it's very hard to measure. A lot of real estate is privately owned, you know, families, small LLCs, partnerships, things like that. So getting the data both on the size of it as well as, you know, and unlike the stock market, there's not a quoted market value for every piece of property. And so it makes it very difficult to estimate the actual value. The same thing with returns. As we get into returns, it's somewhat difficult to measure the returns of commercial real estate. There's no, you know, S&P 500 that's measuring it. There are indexes. NCREIF Property Database is probably one of the best, where they've tracked individual properties as they've changed hands over the years, and so they've been able to track it by individual properties. But you know, none of the ones I own are in that database, so it's not a complete index. But by any measure that we've looked at, typically we're going to see higher returns in equities and bonds, as well as lower end of the risk spectrum as measured by volatility. It's a really good risk-adjusted return. One of the other benefits, you know, we're listening to the DFA presentation this morning about all the headlines of stock market crashes and things like that. And I think one of the understated benefits of real estate is there's no market price. And so if you're invested in real estate and the property is continuing to perform well, rent checks and profits are coming in, you don't have that sort of up and down cycle and the anxiety that sometimes comes with investing in the public markets. You can see here, this comes from Bloomberg, NAREIT, and the NCREF database. You can see commercial real estate there, some good returns, lower volatility, than equities. Once again, you have to, it's very difficult to measure this sort of stuff, but it is, most of the databases that you see, it does provide that type of return. One of the other reasons we like real estate, cash flow and growth. And we'll talk about the tax advantages of it. It's tax advantaged cash flow. And so at the end of the day, I have this theory, we invest in things and we buy and we invest, but at the end of the day, when you go to the grocery store, they want money, okay? They don't care what your house is worth. They don't care what your portfolio is worth. They want actual money to buy things. And that's one of the things I like about real estate. It actually produces tax-advantaged income. The other benefit is it grows. And just like as a stock grows, you're not taxed, at least not yet, on the growth of that property every year from year to year. So the growth in that property is able to grow tax-free. So you have the two components, the income and the growth of the property, that make real estate an attractive investment. The second bullet there, it does produce a lot of income. Historically, 70% of the growth and return of commercial real estate has been from the income itself. At the end of the presentation, I'm going to walk through a couple of case studies, some examples, where you'll see some pretty large rates of return based on a buy, hold, and sell numbers. But the reality is, the type of real estate investing that we advocate, that I advocate, is a cash flow vehicle, and 70% of the returns come from that. Here you can see, once again, from Bloomberg, NCREF, and NAREIT, commercial real estate comparing favorably, 20 years ending 18. Once again, look, I'm just like you guys. You can cherry pick any data that you want to show a positive return. But the reality is, over long periods of time, commercial real estate has proven to be a good return. Now, just like most markets, as I stand here in 2019, there's a lot of interest in real estate, and some of the prices have begun to creep higher. And I'm going to talk to you later in the presentation about how to avoid getting caught up in some of that stuff. Inflation. I like this little cartoon. Inflation protection is really good with commercial real estate. Historically, if you look at the rate of increase in rents versus inflation, it compares very favorably. And for those of you how many out there rent an office building and have a commercial lease in it? Does it have an automatic escalation clause in it? Yeah. So every year it automatically goes up 3%, CPI +1, +2, whatever. Commercial real estate is very, very inflation resistant, because most of your larger companies that put together real estate leases, they're going to have an automatic inflation increase in the lease agreement. Here we compare the growth in CPI to net operating income. It typically hovers around CPI. You'll notice there, as the past couple of years, it's really sort of outpaced inflation, which is good if you own it, is bad if you're a value investor. We have seen rents increase a fair amount, but the point of this slide is just to demonstrate that it is a very good inflation hedge. NAREIT did a study. This was an interesting study they did. They looked at time periods that were considered high inflationary periods, and then they looked at the returns of different asset classes and how they did. Commodities and REITs, hand in hand there with high inflation. The one that really surprised me was TIPS, inflation-protected securities. Only 57% of the time did they actually successfully protect investors from inflation in high inflationary times. Stocks actually did better. And then gold, as you may or may not know, it's a lot of people say it's a good inflation protection. It's actually not. But it's kind of interesting to show you the protection of inflation. So if you're looking for that in your portfolios, it's a good source of that. Diversification, another reason, we put different asset classes in our portfolio. Once again, this comes from Bloomberg, NCREF, and NAREIT. We do see some positive correlation there at 0.15 with equities. So there is a positive correlation with that. As I said before, because there's no market price, you don't feel that correlation. I'll talk about this some more later, but investing through the Great Recession for people like myself and our clients that aren't overly leveraged, no effect whatsoever on our real estate portfolio. We're not concerned about the market price. In fact, when you're investing in commercial real estate, a lower price actually magnifies your return. Just think about it. If you're getting the same amount of rental income and the price drops, your rate of return is actually higher. Last section, taxation. Taxation of real estate has a lot of favorable components to it. I'm going to briefly touch on some of those here. Number one, business deductions. So if you own the property yourself, those business deductions are available to you on Schedule E as the owner of the property. We live near the beach, and so a lot of our clients, it's their dream to own a beach house, and certainly without abusing that, they are allowed to deduct their mileage and things like that, going to their rental properties to check on them, to check tenants in or whatever they do. Even if you own your real estate through another entity, as we're going to talk about, someone's getting the business deduction for that, and so it makes the tax advantage on the income side. Number two, capital gains. I mentioned already tax-free growth. The property hopefully is increasing in value, and the value of that is not taxed from year to year. Number three, and this is a huge one from a cash flow perspective, is the depreciation. A lot of the deals that we will invest in are a typical cash on cash return is going to be 8, maybe 9%. The first year or two of that, you pay no income tax whatsoever because of the depreciation, acquisition costs, which kind of fall into number one, business deductions. And so it's very tax advantaged cash flow. Now, of course, if you sell that property, for those of you that know, that depreciation gets recaptured, which is where number 4 comes in, tax-free exchange. And this is I can't understate the wealth building potential of the 1031 exchange and going from property to property and continuing to build your capital. So a little example, just consider, let's say you put $100,000 into a property and it's producing an 8% return on the rent income. And let's say it grows over several years to $150,000 in value. You do a tax-free exchange into another property that also is producing that 8%. Now your capital base, $150,000, is now producing that 8% return for you. And so this is a great strategy to continue to build not only equity, but the cash flow to go do other things, either to live on or divert that money. We have a lot of clients that their income goes straight into they don't need to spend it, it goes straight into their Schwab portfolios as additional investment into their other investments. Part 2. Number 1, no self-employment tax. So if you think of types of income, what's the worst type of income you can earn is wage income. You've got income tax, you've got Social Security tax, you've got Medicare tax, things like that. Of course, capital gains and qualified dividend income is tax advantage. Real estate falls somewhere in the middle. It is ordinary income, but it's not subject to self-employment and Medicare tax. Number 2, that tax-free equity growth that we talked about. And number 3 and 4 are some interesting twists that just came in with the Tax Cut and Jobs Act. Number 1, if you haven't looked at any returns yet for 2018, you may have noticed that REITs are actually eligible for the 20% qualified business QBI deduction. Just public REITs. I mean, that instantly gives them somewhat of an advantage, that dividend yield that they throw off, it gives them somewhat of an advantage. And then number 4, under Section 199A, which is the tax code section that provides for that qualified business income deduction, certain types of real estate, and I could do an entire seminar on what qualifies for the 199A deduction. Suffice to say, triple net leases do not. So a triple net lease is where the property owner has nothing to do with it. The tenant pays the taxes, insurance, maintenance, things like that. But there's a whole host of ways to qualify for that 20% Section 199A investing in real estate. So once again, that's another advantage that was just as part of that tax act. When you look at the income for most of the types of real estate investing that we recommend, you can take 20% of that income off the top as a deduction. Very, very tax advantaged. All right, let's talk about risks. As I said, there's nothing that isn't risk-free, and this is one of the things that we have a lot of discussions with our clients is the risks that are involved. Number one, and I've highlighted the two, maybe hard to see, but I've highlighted the two biggest risks. Number one is debt. Okay, why do people that invest in real estate not make any money? Why do they go bankrupt? Why do they not make it? Number one reason, debt. It's as simple as that. If you have a low debt to equity on your property, you sail through 2008, 2009, no problem. If you're leveraged 90, 95%, and the economy takes a downturn, you start to have tenants leaving, you can't make the payments, that's when you're losing the properties, frankly, and that's when I'm buying your property. So watch the debt. That's the number one thing. I say it so many times, but when you hear about these disaster stories of people investing in real estate, that's why. The deals that we do, we're typically looking somewhere around 55, 60, maybe 65% debt to equity ratio. So if you think of your down payment, the typical 20% down, we typically like to do deals with double that, 40% down, 45% down, so that we have a huge buffer against any downturn in the economy, which is one of the risks, the overall economy. People that have a concentrated positions in stocks, that they have a lot of risk there. The same thing with real estate. So when we build a real estate portfolio, we diversify by geography, by different types of properties to try to mitigate that. But obviously, when the overall economy is down, real estate is not completely immune to that. Although I will say, think about this, the number one returning asset class for real estate in 08 and 09 is multifamily. People losing their jobs, people losing their home. Where do they live? They got to go live in an apartment. And so multifamily housing apartments are one of the most recession-resistant real estate sectors that there is, because people need a place to live. But the overall economy is a risk. Number three, mismanagement. So this is a key one. You could have a property that's mismanaged. The people that are running it, collecting the rents, allocating capital, reserves, things like that, they can do a poor job. They can do a poor job of marketing the property. They can do a poor job of upkeeping it to where nobody wants to live there. I think that's pretty self-explanatory. Number four, environmental. This includes, hopefully not when you buy the property. Hopefully you're smart enough to get a phase 2 environmental and you don't buy a property that's sitting on top of a EPA Superfund site or something. But hurricanes. We live in North Carolina on the coast. Hurricanes is an issue. We got a couple offices out in California that, they're either getting burnt up by a wildfire or earthquakes or things like that. So there are environmental risks. Of course, we're covering those with insurance on the properties, but you're not going to make, your 8% return or your 30, 40% IRR if the place is wiped out with a hurricane. You just want to get your money back. The next one that I've also highlighted, this is where people get into trouble as well, speculative deals, okay? There is a place for that. Someone has to buy, raw land and build a shopping center and try to entice people to come there. I'm suggesting for you and for most clients, that's not what we're talking about. We're not talking about trying to predict the growth of some major city and buying land that's in the fourth ring of the city and sitting on it for 20 years. That's speculative. Building a new strip mall and hoping that you get an anchor tenant, that's speculative. That's the other big area that people get into trouble. And I get calls for this all the time. Hey, there's a new freeway going in here, and we're going to buy all the land around this freeway exit, and we're going to get, gas stations and things like that. Great, that's great. You go do that. I'm going to stick with things that actually have paying tenants and income coming in. Once again, that's where people get into trouble. It's almost like venture capital, private equity. There's a hope, there's an idea, and people, look, let's face it, people make a lot of money doing that in real estate. But one of the things that ties into the last one is don't confuse investing in real estate with a business, okay? If you're in the business of real estate, yeah, you may want to buy some land out in the middle of nowhere or try to develop a new shopping mall or something like that. We're not in the business of real estate. We're investors in real estate. And just like our, Graham said, investing is an endeavor where you have the reasonable expectation of a return on your money. And so staying out of the speculative deals wipes out a lot of the losses in real estate. So just keep that in mind in terms of risks, debt, and speculative deals. So when I talk about investing in real estate, I'm talking about income-producing properties. They're actual tenants, that there's money coming in already month after month, that for whatever reason, the current owner, it's no longer appropriate for their own personal circumstances, or if they're a business, their business model. And keeping those two in mind will keep you out of a lot of trouble for real estate. I do this flipping house I mentioned in the beginning. I've done that. It was a business. It was a business of flipping houses. I see that's kind of a trendy thing. People want to flip houses on the side. We have clients that do it, and they don't make a lot, and they lose a lot of money doing it. So this is not something that, don't confuse that business with investing. Okay, let's talk about the investor profile. Who is this right for? Who is the best person to invest in real estate? While not a hard and fast rule, we require that somebody has their core investing and financial plan in place, that they have other investments, they have their retirement plan, they have a taxable account of at least $500,000 liquid outside of their 401k, outside of IRAs, things like that. That this is not something that your Gen X person or Gen Z walking in the door, their first job, that they have, that you want, oh yeah, let's go out and buy some property. You hear that a lot. That's just not our strategy. We prefer to have somebody's a core plan in place, at least $500,000 liquid. Kind of jumping to the bullet below that, they have to be an accredited investor for syndicated real estate deals, which means they have to have at least $1 million net worth outside of their primary residence anyway. So it kind of narrows down the field of who this is appropriate for. Number two, they have to understand the processes and the risks. 90-year-old widow with $5 million that doesn't understand this, we're not going to recommend this to them. They have to understand what's going on. Unlike a Schwab account where you just click the mouse and you have discretion and you can buy for them, real estate, they're going to have to, especially in a syndicated deal, they're going to have to sign some forms and some things like that. You don't want to get them into that, or something at tax time, all of a sudden this thing called this K-1 shows up and they weren't aware of that. So you want to make sure that they understand the processes and risks. Number three, and this may seem obvious talking to a group of advisors, but they have to have an advisory team to assist with it. Is this a good group to invest with? Is this a part of, how does this fit in my overall plan? And just a group of people that know what they're doing, that can look at the deal the private placement, if it is something like that, or a private REIT, or whatever they're looking at, that someone can look at it and help them evaluate it. We already talked about the accredited investor for syndicates. That's, Reg D, that's required. And then the last little bullet there, debt to equity. If people want to do it themselves, once again, go back to my previous slide about confusing a business with an investor. We do have clients that they are in the business of real estate. And so our job then kind of shifts from picking the actual properties or helping them do that to helping them manage the risk, look at their overall debt to equity, look at the percentage of real estate that they have as compared to their net worth, things like that. I will say in general, unless they are in the business of real estate, we discourage people from buying investment property on their own. Unless it's a second home, like I said, we're near the beach, and it's something they want for their family. Maybe they rent it out, during the summer, and their family uses it. So it's a quasi investment property, but it's mostly, it's partly at least a second home. But for people that are buying rental properties on the side, and run the numbers, we have a real estate cash flow spreadsheet little tool that I built. We'll compute the IRR that their property is making. And you look at that, and most of the time when people come in, especially with single family rentals, you look at the return they're making and you're like, gosh, we could put this in treasury bonds and you would have no hassle, no risk, and you could make what you're making now. So even if you don't want to recommend that they invest in real estate or you're not confident in it, I really encourage people to figure out a way to help clients analyze the return of the properties that they do have, because most single family rentals are very poor investments when compared to other things. Now, once again, flipping it around, if it's your business, at one point I had like 30 single family rentals. It was a business, okay? That's different. I didn't have to worry about one person leaving and being without rent for a month or two. But if you're just going to buy one or two houses, generally not a great idea. This is another question I get a lot, is real estate and IRAs, and this is frankly where I see a lot of the abuses and the late night infomercials and hotel seminars and things like that, is using your IRA to invest in real estate. It's usually because the person doesn't have any other money. They don't have enough money to invest in real estate, and so the real estate person that's selling them the product or whatever, they're encouraging them to use their IRA or borrow from their 401k and put it into real estate. We generally don't recommend an IRA for real estate. Once again, it goes back to your typical client for this. Their IRA is not going to be their largest asset. Real estate's already tax efficient. It's not as egregious as putting an annuity in an IRA, but real estate is already very tax efficient. So putting it inside the IRA, yes, you're going to shelter that cash flow income year to year, but generally speaking, we don't do it. And then the last one, just the complexity of doing it. It's already a little bit on the complex side, investing in real estate for your clients. You throw in an IRA, you've got to have a different custodian, you've got to have more fees, different things like that. And then of course the last little bullet there, the self-dealing. You don't want to accidentally invalidate your entire IRA. So generally we like to keep those real estate out of the IRAs. All right. Asset allocation. This is something that, how many of you remember the old three-legged stool of retirement? Yeah, a couple people. I see Stephen and Sue have no idea what I'm talking about. But yeah, so it used to be a pension, your Social Security, and your investments. Well, I have a different three-legged stool. This is what we teach at Blue Sky, is we encourage our clients to develop multiple streams of income. Number one is what I call paper assets. Stocks, bonds, public REITs, the stuff you find in your Schwab account. Number two, income-producing real estate. And number 3 is ownership in an operating business if you can get it. One of the things, I don't know if anybody was in here for the business presentation before this, but one of the things they skipped, they said, how does a business owner get rid of his business? Liquidate, sell, or gift. I went up to him afterwards. Actually, the 4th option is my favorite, which is own passively. Figure out a way to own the business passively so that you don't show up on a day-to-day basis, but you're still at least a part owner. So if you can't do that, we'll typically add that to one of the other allocations. But I just wanted to throw this up there for you is we do believe that this is an important part of someone's portfolio. That number there may be way too high for you. You got to figure out what this is in your firm. If you want to invest in real estate, have some sort of criteria of how it fits in. Hey, if a person meets the criteria, we're going to allocate 10% or 20% or whatever the number is. We typically vary that based on somewhat of the sophistication of the investor. Some people that have already had real estate experience, we'll easily run that number up to 1/3 or more. For somebody just starting out that is maybe not completely in tune with it, it may be like 10%. But I put that up there. That's the way we do it. I'm not suggesting everyone needs to do it that way, but figure that out so that you have a strategy and you can explain it to clients. All right, portfolio design. We'll talk about how do you design a real estate portfolio. And this is actually no different than what you do with your liquid assets. Is you want to be diversified across different types of investments. And so we break real estate investing down into 4 different things. Number 1 is strategy. What's the strategy? And I'll talk about what each one of these means. Number 2 is the type. Number 3 is location. And number 4 is the actual investment vehicle that you use. So strategies. Number 1 is what we call core strategies. These are up and functioning properties. They're typically going to be a little bit nicer building in more major metropolitan areas, but they're core assets. They're not going to all of a sudden go out of business or be completely vacant with tenants. Number 2 is what we call value add. For those of you, how many are value investors? I am. I like to get a good value. So a value add property is one where, for whatever reason, the current owners have not kept up with rents. You see this very common with family-owned properties. Is we'll look at a property and there'll be tenants in there, and I'm not talking about rent control, New York City, things like that. I'm just talking about the owner's discretion. Rents haven't been raised on people in 20, 25 years. Very common for small operators of small apartment complexes, strip malls, things like that. They get this personal relationship going with the tenants, and the property just falls behind. So that would be like a value add. Or maybe they didn't keep up with the maintenance, and the places aren't fresh and new. But for whatever reason, there's nothing fundamentally wrong with the property, but there's a chance to upgrade it. We work with a company out in the West Coast that their specialty is buying multifamily apartments in California and urban, like young urban millennial Gen Z type things, and they take these complexes and they institute these programs like recycling. They build community programs and some of the things that the younger group is looking for in the places that they live, and they're able to take some of these old 1970s, 80s apartment complexes that were kind of dwindling, and and they turn them into these vibrant communities that then, like in Sacramento or places like that then all the younger people, they want to live, and the rents just go out the roof. So that's like a value add. There's something that they can do. Opportunistic. This is your land deals. This is a vacant place, a new shopping mall. We typically don't do a lot of that, but it's more on the risk spectrum. If you think of risk, on the far left is least risk, over to the right is going to be most risk. Property types, pretty self-explanatory. Number one, multifamily, apartment complexes, essentially. Retail, everything from strip malls to standalone places to shopping malls. Office space, industrial, flex space. Flex space is a popular one where you have like a storefront, but there are like loading docks in the back. Is industrial. I don't do a lot of like manufacturing, like heavy industrial, but like light industrial. And then there's other mobile homes. Mobile homes are actually one of the best investments that you can do. I mean, in North Carolina, there's a lot of mobile home parks. And I mean, your cash on those things is like 25%. I mean, think about it. You spend like 45 grand and you drag a trailer out in the middle of a field and you charge like $1,000 a month for it. I mean, it's crazy. Now, there is some risk, like hurricanes and tornadoes always seem to find their way right to mobile home parks, so there is some risk there. But anyway, college housing, some of these niche things, that there is some good opportunities in those areas as well. REITs, this just kind of shows you the relative breakout of REITs, retail being number one, holding and development number two, diversified office. So you'll notice what I want to point out is that the top two of the three are diversified and holding type companies. So just like your portfolios, we want to have a diversified real estate strategy. So that brings us back to my chart once again that I introduced in the beginning, and we're going to talk about now the vehicles that we're going to use to invest in. All right, so let's start on the left-hand side. You'll see own and manage local property. It does have the highest possible returns. If you are in the business of real estate and you know what you're doing and can buy and manage yourself or have a team of people to do it, there is the highest possible returns to do that. It requires the most experience. It's the most hassle, provides the least diversification, least liquidity. You have the most control. You also have the most tax benefits, especially in the business owner, business deduction type area. And of course, you have the fewest layer of fees. As we go over to the right-hand side with your REIT mutual fund or REIT ETF, you're going to get average market returns. You're going to get the return of the market, as we all know. You don't require any experience. There's no hassle. You click a button, free to trade ETF. Man, you're now exposed to commercial real estate in the United States or globally. Has the most diversification, liquidity. That same mouse that you just bought with for no cost, you can click again the next day and sell it for no cost whatsoever. Very liquid. You have no control whatsoever of the Simon Property Group or some of these other big REITs. Less tax benefits. I say less. The 20% QBI was a real boon to REIT investors. I'm still not quite sure. They must have had a good lobby group to get that in the tax bill. And of course, it has the most layer of fees. Although the Vanguard, the Schwab, there's minimal fees at that level. But that's kind of the continuum. So as you move to the middle, the second from the left. Hired management, where you're not managing yourself. There's also what's called turnkey properties, where groups will find and sort of tee up rental properties for investors, and you just kind of show up with a check. The middle, syndicated properties. This is really what I'm going to talk about at the end, which is where I believe the best mix of the left and right side of the continuum exist. And then going over to the right, you've got your private REITs, and then, of course, individual public REITs, and then the mutual funds. So this, to me, is a headache. In order to make the money that you need, it does require a lot of involvement if you're going to own and manage your own properties. Unlike maybe the stock market that you can buy and hold forever, a real estate property is not buy and hold forever. If you do not continually update, renovate, and position that property, it will go downhill. It is a depreciating asset. And so there is a component of management of real estate that, as you know, we don't, if you're a passive investor in your portfolio, real estate is not buy and hold forever. You have to maintain it. You have to keep up with it. The better real estate operators do cycle their portfolio over time. Okay, on the right side, we already talked about this. I think everybody's familiar with the public REITs. There are different types of REITs. There are private non-traded REITs. There are public non-traded REITs, and there are public traded REITs. So just spend a minute on that. There are some new organizations, like one of them that comes to mind is called Realty Mogul. I'm not endorsing them or anything. I'm just giving you sort of the landscape of being able to log into a website for relatively low minimums, access the public non-traded, more private type REITs, a little bit better return than the public REITs, a little bit less liquidity, but we're starting to see, in fact, in the Wall Street Journal, did anybody see that article about 2 or 3 days ago on the company that's going to offer the ability to invest in private real estate for $100 minimums through this online platform? Did anybody see that? Yeah, so there's definitely the sort of Internet of Things is coming to real estate, and there's more and more methods. So even if you don't recommend it to your clients, I just encourage you to understand what's happening in real estate, how people make money in it, how people don't, and the vehicles that are available out there, because there are a lot of large proliferation. As you know, the SEC changed some of its regulations as far as private capital, raising private capital from smaller investors. And so a lot of real estate companies are trying to take advantage of those new exemptions as well. Yes? Sure. There's a lot of, and I'm going to talk about this in a minute, there's a lot of mediocre to awful real estate products out there. There really is. And of course, for those of you remember the 80s and the limited partnerships and that kind of stuff, this is why it's so important that the client understands what they're getting into. I personally don't like private non-traded REITs. I like the syndicated deals where it's the people that are running the thing on a day-to-day basis. It's a smaller group of investors. It's not this giant type private REIT. So in fact, this is where I am. Lots of choices in the middle. A lot of people, just like you see in the tech bubble or whatever bubble you're talking about, when the returns start to get very frothy, there's a lot of people recommending that you invest in real estate. And there's a lot of different deals. We have some NAPFA partners that do this sort of thing as well. This is where the due diligence comes in. This is where we really add the value. I had a conversation with a client that was like, well, I don't like that. I don't want to invest in that. And I said, look, I've been investing in real estate for like 30 years, but I'm an investor. These folks do this as a full-time job. They visit the properties. They do the due diligence. You looking at a slideshow of 20 slides, you can't evaluate that property like they can. And so our job is really to do the due diligence, not on the properties, but on the people that are running the real estate, assuming you're not doing it yourself. Somebody was telling me there was some NAPFA member that actually puts the deals together themselves, that they form the LLC themselves. We actually used to do some of that, but the compliance for that is just a nightmare. So we don't choose to do that. So the key function I see as the advisor is designing that strategy, doing the due diligence of the thousands of different options that there are out there today. So here's where I'm going to talk about the syndicated properties. That's my term. Some people call them Reg D offerings. Some people call them private LLCs. By syndicated, what I mean is there's usually a sponsor. There's a company that does this for a living. They find properties, they run properties, and they raise their equity from investors. They're syndicators. And to me, it's the best of sort of the left and right side of the chart. And really, once again, unless it's your business, it's the farthest that I recommend people go on that continuum. But the key is doing the due diligence on the sponsors themselves. I'm going to go through a couple of sample deals, and I debated whether to do this or not. I've been doing this presentation for years, and I do like to show people this. Just like we've been in a bull stock market, we've been in somewhat of a bull real estate market, so the numbers are what they are, but I don't anticipate these type of numbers going forward. By the way, all of you can't necessarily do this, but I invest in almost every real estate deal that we ask our clients to invest in. Even the sponsors will usually, if you can't do the minimum or whatever, it's good for you to invest. Just like my Schwab portfolio looks exactly like my client's Schwab portfolio, is I typically invest in these myself. Also, one of the key things you want to look at is the amount of money that the sponsor puts in, okay? So I've seen some, it'll be, a $10 million deal and the sponsor puts in $50,000. No way, I'm not investing with those people. That's not enough. They have to have their own equity at risk. Just like mutual funds, like I said, I'm a passive manager, but if you were to pick active funds, one of the key indicators of funds that may potentially outperform is ownership by management. And it's the same thing in this, is when the people putting the deals together have significant money, it really makes a difference. Okay, so this was, one of the other things I want you to notice is when you look at the pictures of these places, like I would never buy a building in Chicago. Never. You're going to look at these and you'll be like, wow, that's really underwhelming looking property. That's exactly right, and that's where you make money. You don't make money buying this high-rise building. Somebody does, but there's a lot more opportunities in second-tier markets, smaller properties, because the market is not as efficient. The type of deals that I typically like are going to be maybe $3 to $10 million, some of them up to maybe 20, 30. And so what you do is all the institutional money, all the Wall Street money, which I stay away from those people. You want to get away from whatever they're doing. And it's too small for them to do. They have too much money to get involved in these things, and that's where you can find some value, you can find some inefficiencies. So this was a complex near Durham, North Carolina. It was a 49-unit townhouse community. We bought it in 2015 for about $2.6 million. You can see we bought it at I'm sure there's a pointer on this thing, but you can see we bought it at a 10.4% cash on cash, going up to 11.25, and we were able to sell it in February of 2018. So the annualized IRR on this was about 44%. You say, well, why is that? Once again, look for something that you can marginally add value. This one was, as I said, family-owned asset. And we brought in a third-party manager, a professional real estate management company that added a website. I mean, you may not be able to read that. They actually put a website up to advertise, hey, come live at our apartment complex. Just some little stuff, which enabled us to sell it in 2018 for quite a premium. Once again, it's nothing overly fancy. It's some place you drive by and not even notice. And this is where the opportunities are generally found. Yes.
So, good income stream for the offer.
That's a great question. So the cash on cash was very good. This was a little fast. Typically, we want 5 to 7 years, but if a buyer comes along and offers us what we think is more than market value, we'll sell it. And the answer to your second question is, each investor in this, so this one, I can't remember exactly, there was maybe 25 or so people. Each person is offered the opportunity to 1031 exchange into another one. The investors do have the option to take their money out if they wanted. And in fact, this next one, Georgetown Apartments, this was actually a client of ours that owned this. And it was a 110-unit community. The family had owned it for 50 years. And this is kind of a funny story. Well, it's not funny, I guess your perspective. But the husband ran it, and he was married, his first wife, and then married a second wife. And unfortunately, he didn't ask me, or his estate planning was already done before we got involved. But when he passed away, his first wife owned 50%, and his second wife owned 50%. The first wife, yeah, it was crazy. And the first wife was like 82 years old, and the second wife was like 60. Neither of them knew anything about real estate, anything about running a property, whatever. That's the type of property. So we got them a fair price. Like they got a fair price for the property, but it had not been maintained, the rents hadn't been raised, or whatever. In this particular case, the one widow took her money. She didn't want to do a 1031, she wanted the cash. And the other one did, and did a 1031. And so there's ways that you can do that depending on the individual situation. So this was another one, a cash on cash, about 9.75%. This one is still owned. Once again, we think there's a lot of upside value. It also takes capital. So that's the other thing, is that to bring it up to speed, I know this property very well, so the heating and air units hadn't been replaced in probably 20 years. They were all, 110 of them probably needed to be replaced. The other thing I forgot to mention, on these, the sponsor is the guarantor of the debt, okay? Which is a key distinction when you think of my spectrum from left to right. On the left-hand side, you or the client is signing the mortgage. It's when you hit the syndicated property line, you are no longer liable for the debt. So none of the deals that we do, that's why they make money, and I'll show you at the end how they make money. But the investors provide the equity, and the sponsor guarantees the debt. They go get the note. So if something crazy happened and the property did not make it, which has never happened to me before, the investors have no liability for the debt. Yes?
On this property, how much cash did they have to put into it to bring it up to speed?
This one was probably, it was about $300,000. Yeah. So that's the other thing, is a lot of times you have these family owners that they just don't have the money to bring it to where it needs to be to get market rents. So this was another one, Westchester Square, kind of the similar thing. Once again, I just want you to look at these pictures. And this one, it was in Danville, Virginia. Once again, anybody here at Danville? It's actually a beautiful place. Yeah, you guys from Virginia Tech. It's down there, Southern Virginia. Anyway, it's just a good solid property. Once again, the owner was mismanaging the property. 13 vacant units, 8 of which needed substantial work. Once again, $300,000 for capital expenditures to bring it up to speed. But then you look at the, I know it's in here somewhere, but the cap rate improvement you get, because a lot of the real estate buyers, especially the larger buyers, they're not going to improve the property. They just buy it. They want to collect the rents and pass it on to the investors, your big funds and things like that. They're not going to go in and actually improve the properties. This was a flex space in Morrisville, North Carolina. I just want to show you a different kind. This is a little bit more modern looking place. It's a newer place. It's outside of the Charlotte metropolitan statistical area. Another example, this one we just closed on this year sometime. I can't remember, maybe March or so. The way these work is typically there's quarterly distributions. The reporting is most of the people are going to have an online portal where the client can go and view profit and loss statements and all the information they could possibly consume. It's always set up as an auto distribution to their checking account or their Schwab account, typically paid out quarterly. So they simply collect the rent, subtract out the expenses, whatever's left, they take some for reserve and they divide the rest up amongst the investors. So we try to get a bunch of these properties going at different times, different quarters, so that it creates this income stream for clients. This was the pro forma on the purchase of this property. So you can see I highlighted a couple things. Once again, 60-40, 40% down payment, very conservatively financed. Projected cash on cash returns, 8-9%. A preferred investor return. Has anybody invested in anything that had like a preferred return before? Okay. So just take a minute to explain. What does that mean? It means that the investors are entitled to an 8% return annualized, 8% annual return prior to the sponsor getting anything. That's what a preferred return means. So if for whatever reason the first year the cash flow does not equate to at least an 8% return, then it has to be made up in future years. And we see it generally, increasing cash on cash return. Project level IRRs. You saw some eye-popping numbers in the other ones. I always tell people 7-8% cash on cash, 15 to 18% IRR, and that's sort of what we tell people to expect. And then you get these 30-40% things that pop in there, but I tell people that's what to expect. The last slide I want to talk about, and we'll have a little bit of time for questions. Typical deal parameters. So how do they make money? So one thing I failed to mention, Blue Sky, we're a flat fee advisor, by the way. So we charge a flat fee to our clients based on the complexity of their situation and what we need to do for them. So you may be asking, how do we make money? Well, we don't. Like, this is part of what we do. And someone comes in the door and we think it's an appropriate thing to do, it's built into the flat fee that we charge them. We have no affiliate. Obviously, I'm a NAPFA member for 20 years. We don't get anything. That's the most puzzling thing for people that we talk to is they're like, well, how do you make money? And like, well, the clients just pay us a fee. Like, this is what we do for them, just like their Schwab portfolio. We help them design a real estate portfolio. We don't have any affiliation with the sponsors that we work with, the syndication partners. We get no money from them. In fact, they come down, they want to take us to lunch, and I'm like, great, you can come down for lunch, but I'm paying, I don't even want a free lunch from them. So it's completely, we're fiduciaries. We're fiduciaries when we're recommending this stuff. In fact, in our investment policy statement for real estate, it says, our recommendations to you are in accordance with the fiduciary standard. We think this is the best thing for you, your circumstances, and in no way benefits us. So how does the sponsor make money? Typically, they're going to make 1% of the purchase price. This covers their due diligence. This covers, flying all over the place, looking at properties, things like that. Number two, sponsor investment participation. The groups that I work with and the ones that I recommend have to have a minimum of 10% of the equity is from the sponsor themselves. Number three, they do have, typically, you're going to see an asset management fee, an annual fee that helps cover the cost of their management, taxes, legal fees, all that sort of stuff. Investor preferred return, as I mentioned already, most of the deals we're seeing are somewhere around 8% cash on cash, so the investor makes their 8%. Anything over 8% is split 75% to the investor, 25% to the sponsor. So while there are some fees sort of above the line, those typically are covering costs. They're not really making money. The groups we work with, now there are groups, the bigger Wall Street firms and things like that, they're making their money on the acquisition fee. You know, they're doing a $50, $100 million deal. They're just trying to do deals. I recommend looking for sponsors that make their money down here. When you're successful, they're successful. That when they're making over 8%, they're getting 25% of that. And then on disposition, if you, for whatever reason, I've never seen it happen, but if for whatever reason you haven't got your 8% yet, you will get your 8%. You get all your money back. So if you put in $100,000, you're going to get at least $108,000 back. Sponsor does typically get a 1% distribution fee, and then the proceeds are split 75-25 to the investors and the sponsor. This is a very typical deal structure that it's what I look for. Like, you'll find all sorts of other stuff out there, but this is what I look for. It gives the sponsor the right incentives, and it gives our clients the right return for what they're doing. Okay, and then my favorite, I love this slide. Anyway, what questions can I answer? Yes, sir. Good question. I talk to a lot of people. So I prefer smaller ones, where I can meet with the person that owns it, the brains behind the operation. So that one thing. I look for a track record, and I look for those things that they're investor focused, that ones that are mostly taking individual money as opposed to institutional money. You know, if they have a $5 million institutional investor and you're putting in $500,000, you know, that's not. So we look for ones that rely on individual investors, and ones that line up with sort of my investment philosophy, conservative debt to equity ratios, those type of things. But it's just talking to a lot of these folks. Yes.
Yeah, can you expand on what your criteria is for debt to equity ratio, what you like to see and don't like to see in specific numbers?
Sure. So anything over 70-30, I'm not going to do it. That's pretty much the top that I'm going to do. If you get much below 50, your rate of returns suffer. As you probably know, one of the benefits of real estate is the leverage, and that's how you can get 44% annualized rate of return. It's because you're leveraging. So I typically like to see that 60-40 debt to equity is where I like to be. Mm-hmm. Yes.
What's your average client investment in any one?
Great question. So as part of our investment policy statement, we design not only an aggregate amount, say, hey, you need to have $3 million invested. We pick a dollar amount per investment. Most of them are going to be, we target about 100,000, some per deal. Some of them will have a 50,000 minimum. We typically want to get at least 5 deals. So if you have someone that's on the smaller side, we may do 5 at 50,000. And then your larger clients, 100. We have some clients that are doing, a couple 100,000 a deal. It depends on the size of the client, but your minimums are going to be at least 50. In that case, I kind of question whether it's right for the client if they can only afford 50 a deal. So typically our minimum is a client is going to put 100,000 into a deal.
And they'll have more than one deal.
Right, that's what I was saying. At least 5, preferably up into the 20 range is where I like to be. Sure. The risk slide is, number one is debt. The people that do it with too much debt and an economic downturn or not the perfect location. That's why that debt to equity ratio, you got to watch that. Number two is the mismanagement. So when you're looking at who to sponsor, look at, do they use a third party? Like the ones I deal with, they use a third party management company that, like nationwide management companies, that they know how to manage an office space or something like that. So that's the other place I've seen them get into trouble is mismanagement of the property. And then number three, it's the speculation. It's the speculation. It's the, this is the, new building.
Guaranteed 50%.
Yes, exactly. And ground floor, new development, new shopping mall. And yes, somebody makes a lot of money on those things. Just, that's not where I want to be. It's not where most clients want to be.
Thank you.
Any other questions? All right. Well, I really appreciate everybody sticking around. I know this is the last session. I hope you got something from it. If I can ever help any of you, please let me know. You can look us up. I didn't think I put my contact information there. I'm sorry. But it's blueskywa.com. You can find me, or I think I have a couple business cards left, but be happy to help any of you with this. All right.